JP, thanks very much for doing this today. Good to have you on this afternoon.
Likewise, Ben. Happy to.
Brilliant. Well, JP, look, I'll jump straight to cut straight to the chase. Obviously, we're in a good oil price environment at the moment. Definitely a lot more positive than that which we've been experiencing over the past couple of years. So I just want to get your take on that. So, what is the state of the current oil price environment, and is $100 oil here to stay?
That seems to be the question of the moment. Look, I think we are not in a Goldilocks period. I think there is a protracted environment, prolonged environment of relatively high, and emphasize relatively, but relatively high oil price. Whether or not it stays at $100 oil or not is a burning question for all. But if you look even prior to, and obviously $100 oil was achieved really with the prospect and unfortunate circumstance of what's been happening in Ukraine. But even prior to that, there were natural supply constraints that was pushing oil price into the mid to high 80s, low 90s. Those supply constraints remain intact even while demand is only going one way, right? So you've got public shareholder pressure to return capital on the one hand, you've got ESG pressure on the other hand, both of which has been tamping down supply in the face of improving demand dynamic as the world is reemerging from COVID and manufacturing industry, transportation is all becoming a regular consumer.
No, absolutely. And what does this all mean for capital availability to the sector? I mean, is the E&P industry facing the same challenges that it endured throughout the pandemic? I mean, I know you've alluded to ESG pressures there. Is that still impacting capital availability, or is the high commodity price environment and obviously the pressure to ramp up oil and gas production as a result of the events in Russia and Ukraine, is that making it, say, more attractive, the space more attractive and starting to lure investors back to the sector?
That's a tough or an interesting question. Let's put it that way. As a banker, I can't help but use that word interesting. It's an interesting question. If you look back to actually pre-COVID, the back half of 2019, we started to witness some capital retrenchment, some capital pulling back from the industry. And it really is more of, or at least at the time, was more of a under the guise of ESG, but it really wasn't. It was marketing ESG. The reality was capital performance had been subpar. And so you had a number of funds that were more generalist in nature, but maybe had a pocket for oil and gas, and in particular upstream investing, and they pulled back capital really starting in 2019, and then with COVID hitting and the increased commodity price volatility and low commodity price for much of 2020, you saw further retrenchment of capital. And a lot of that it was amplified by ESG pressure. Where we are today is the universe of capital providers has shrunk, it's diminished. But those who are dedicated to the industry, who understand the benefits and returns and what it takes to generate strong returns through cycles in the upstream sector, they have actually aggregated capital. And so while the universe of capital providers has shrunk, those with capital have actually gotten stronger and are more active today in issuing capital than we saw starting the back half of 2019.
Brilliant. And you talk about those sort of committed to the space being stronger and having aggregated capital. I mean, from that perspective, are you able to just comment on investors, or particularly energy investors' ability to raise new funds? I mean, is there appetite out there for energy funds moving forward? I know it was maybe more challenging, or has become more challenging over the past couple of years. Are we starting to see a recovery, or?
I think we're seeing recovery both at the fund level with select LPs coming back in and investing at the fund level. Maybe less so some of the public endowments, which are facing some ESG pressure from the public populist sentiment, but more so from pension funds and the like, long-term capital, as well as an expansion of family office money that has come back in to support LPs. And then that has trickled down to the operators. And you're seeing capital be invested by fund managers at the operator level, whether it's in private equity, whether it is in private debt or structured products. You're even seeing some management teams, whether they've recently sold out of their assets, or even some newly formed management teams that are getting capital backing from private equity and private debt sources. You're also seeing a rebound a bit in the RBL lending space. And so I would say across the board, capital has come back and is more available today, once again, than we saw even back half of 2019 and certainly through the pandemic.
That's good news for those listening in, I'm sure. And I mean, you've alluded to various forms of capital there, ranging from private equity, private debt, structured products, et cetera, et cetera. I mean, where is the capital that is committed to the space today? Where is that capital coming from? I mean, we've obviously, it's been extremely well documented how private equity or more traditional forms of capital had fled the space. I mean, are they still staying away in this environment? Are they coming back? Are we seeing a more permanent shift towards alternative credit funds and sort of financing structures for the oil and gas and the E&P industry? It'd be good if you could just comment on that a little bit.
Yeah, it's a great question. I think it really depends on the institutional investor platform, right? You're seeing more of the public investor platforms, the Fidelities, et cetera, of the world, investing, increasing exposure and increasing investment really in public forms of security. High yield in 2021, in upstream oil and gas, we saw the most robust issuance of high yield that we've experienced in a decade or more. And that was really driven by more of those public investment funds. Private equity has aggregated capital, as I mentioned, with select LPs that are committed and understand the need for investment, and quite frankly, the benefits of the returns in investment in up and midstream sectors. And so you're seeing a number of pension funds, you're seeing a number of high net worth or large family offices that are aggregating capital towards private equity funds. And the same, quite frankly, for a number of private credit funds. Private credit funds kind of end up playing a bit of a bridge role, because with their set maturity date, they can end up having at least an end date that they can put out there for their LPs as to when they may be out of any particular investment, or may make a determination as to whether or not to continue to invest in the sector.
Thanks, JP. And what are your predictions for the A&D markets and deal flow this year? I mean, are there any headline deals on the horizon as obviously the world looks towards the upstream sector to ease the pressure on energy security and energy affordability?
Look, I think the past 18 months or so have been as active a period in M&A and D as we've experienced in nearly a decade, and that continues today. From the smaller, lower end of the middle market on through to headline deals. There is a very, very high level of activity, a high level of conversation. Whether or not, I think the big question is whether or not we will experience in 2022 as high a close rate of announced deals as we experienced in 2021. Starting really with in the fourth quarter of 2020 and through 2021, we at Houlihan had calculated, based on announced deals greater than $50 million in value, a close rate that was approaching 75%. It was 73-75%. We at Houlihan had 100% close rate, but not to besmirch any of my competitors out there. But somewhere across the industry in the 73-75%. Quite frankly, that's 15 to 20% above the historical average. Typically, on an annual basis, it's somewhere in the mid-50s% close rate. I think we'll start to see a bit of a reversion towards that mean in 2022. I think given where commodity prices are, the keep case starts to become more compelling, and so for very rational reasons, not driven by greed or over expectations of capital returns, but quite frankly, just for rational reasons, we will start to see more and more investors deciding that, hey, if the strip is going to play out over the next 2 to 3 years anywhere near what it's forecasted to do, the ability to return capital, to pay down debt, to return capital to shareholders starts to look, equally, if not more compelling than a sale case. And so I think while we fully expect, and based on our backlog of deals, where currently we have 34 active mandates globally in our oil and gas group, the activity levels are going to remain very high. But it's a question of whether or not buyers and sellers can meet on an attractive enough term to keep those close rates high.
Sure. No, thanks, JP. And I guess my final question then would be, obviously, as the pandemic struck a couple of years ago, the narrative was all around industry consolidation. I mean, does that continue to be the case today? Who are going to be the major movers in the space and in the A&D markets? As you alluded to, there's still a huge amount of pressure to maintain capital discipline, prioritize cash flow, particularly in the public markets. I mean, with this in mind, what assets are rising to the top of the pile, and how do you differentiate the approach of the public operators versus the private operators?
It's a great question. I wish that it were, a simple, straightforward answer, because it really depends on the size of your asset and the development stage of your asset. Private equity has target sizes that they will allocate on a per deal basis, and if you cross over the thresholds, you get over a $300 million size threshold, the universe shrinks a little bit. You get over a 500 million, the universe of potential buyers shrinks a little bit more. You get over $1 billion, and it shrinks quite a bit, at least within the private equity front. And then your more active buyers tend to be the larger, the mid caps and above independents, or even majors, depending on the size of the asset. We do still see and are actively engaged in a number of traditional M&A, corporate level M&A conversations. So not just A&D and among mid and large cap companies, that continues to be a path that we think will find some favor, because at that point you're really talking about relative value and where a merger could be struck, be it at a premium or a merger of equals. And in the A&D universe, we still see capital available for acquisitions. And as I mentioned, it really comes down then to where in the development scale your asset is. The less developed it is, appeals to a certain buyer universe, typically more the public buyer universe. The more developed it is, there is a universe of PDP focused buyers, and you know, all that's driven by the size.
Sure. No, brilliant. Thanks, JP. I think there's a lot more we could dig into, but I'll leave that for the New York Stock Exchange when you join us up there for the assembly in a couple of weeks' time. So appreciate the time, and we'll look forward to seeing you in a couple of weeks.
Excellent, Ben. Thank you very much. Look forward to it.